I'm speaking with Suri Dadella on pattern trading. And Suri, tell me about why pattern trading is important.
Well, pattern trading is one of the most objective way of trading patterns. Patterns itself are quite repeatable, and then they run in cycles. And because of that reason, you can actually predict what pattern is going to do next. So it gives you a very precise way of entering into the markets. And before you entering into trade in pattern trading, you will know exactly where is your what's your risk reward ratio is. Because of that reason, pattern trading, in my view, of course I'm biased, but this is very superior trading than any other forms of trading.
What are some of the components of pattern trading?
Well, the pattern trading involves, of course, both the structure of the pattern itself, which includes both the time and the price structure. And within that, there are a lot of patterns. There's a lot of patterns. In fact, I have written a book about patterns, about 65 patterns. But out of which I say that I may be pretty good fluent in 10 patterns, because nobody can be very fluent in all the patterns. So I use these, out of these 10, my primary way of looking at the patterns is the harmonic patterns. Harmonic patterns means the patterns which use in the sides the harmonic ratios, which are like a fib ratios, they call it. And so those, in that, I think that is probably has a higher probability of success in a harmonic trading. So I use those patterns, which includes both the time and price is very critical. And also the structure itself is where the pattern is forming in the current market. That's a very critical aspect of picking which pattern works and which pattern doesn't work. What I call is a market context. And within the market context, you have to define a structure, and then you find the patterns, and those are the patterns which I trade.
Can you find this same pattern in different time frames, and does that give you stronger confirmation?
Absolutely, absolutely. There is a pattern. Patterns have a couple of concepts. Patterns within the patterns, and also patterns on a higher time frame patterns. And then you're seeing, in fact, higher time frame patterns are much more successful. But when you drill down to a smaller time frame when you're trading it, if you see a confluence of a similar pattern forming in the higher time frame and in the lower time frame, it adds up for the success.
And can you use this for intraday trading, swing trading, long-term trading?
Yeah, the patterns work in all time frames and also in all instruments. Any instrument which has got the basic data like open, high, low, close, and of course the timestamp, it'll work in that. And it also works in range bars and different type of alternative chart types also.
The recognition of it, is it just by practice?
Well, actually, there's two ways. Of course, one is the recognition is visual, because if you had to see thousands of hours in order to practice it. But the other way is to detect automatically. You can write algorithmic programs to detect it, not only while detecting. So if you detect it, then you can also write rules to see where is your, how do you enter into the trade. And then, as I said in the first, the patterns are superior because the risk reward far ahead of it. And patterns also give you multiple opportunities to get into the trade, because even though pattern forming, so as long as the pattern is not failed, you can enter into that pattern multiple times. So that's the biggest advantage about the pattern trading.
Suri, thanks for stopping by.
Thank you. Fantastic. I enjoyed it. Thank you.
I've been speaking with Suri Dadella. You're watching the MoneyShow.com video network.